Students, let's start. Yesterday, we did discuss tax base of some of the common tax bases. They never changes. They will not change. Now let's go ahead. Let me introduce one more concept. For example, in case of land, we know that the tax base is cost. Assuming APLC bought a land costing 100 million on 1/1/2024. So APLC bought a land costing 100 million. Okay. Let's say APLC follows revaluation method, revaluation model. Okay. On 31st December 2024, revalued amount is 120 million. It means that on December 2024, the double entry is land debit by 20 million, revaluation surplus, which goes to OCI, other comprehensive income, credited by 20 million. December 2024, land is debited by 20, revaluation / OCI is credited by 20. Okay. Let's say the tax rate is 30%. Required deferred tax liability. We are simply required to prepare to calculate deferred tax liability and prepare the journal entry. Okay. Carrying amount, tax base, temporary difference. Carrying amount, tax base, and temporary difference, land. December 2024, land will have the carrying amount of 120 million. Can I say the tax base is 100? Why 100? We have already discussed yesterday. In case of land, tax base is the cost of the land, and the cost of the land is 100 million. So there is a difference of 20 million. Since it is an asset, obviously carrying amount is more than the tax base, so the difference is the taxable difference. Difference is the taxable difference. Taxable difference multiplied by tax rate. The tax rate is 30%. Tax rate is 30%. So the deferred tax liability is 6 million. Okay, we have calculated the deferred tax liability. You can see this here. We did discuss yesterday. In case of assets, when carrying amount is more than the tax base, difference is the taxable temporary difference. Taxable temporary difference multiplied by tax rate gives us deferred tax liability. Okay. The question is, what is the journal entry for the deferred tax liability? Here, debit and credit. Obviously, deferred tax liability will be credited. There's no doubt about it. Deferred tax liability. There has to be debit. The question is, what should be the title for the debit? Now, please listen carefully. According to IAS 12, taxation, according to IAS 12, if deferred tax liability arises due to revaluation, then liability will be charged to revaluation. Repeat. If deferred tax liability arises from revaluation, then it will be charged to revaluation. So this 6 million we cannot take to the profit or loss. Why? Logically, the original cost of the land is 100, carrying amount is 120. The 20 difference, which is a taxable difference, is arising because of the revaluation surplus. So the concept is, if your deferred tax liability relates to the revaluation surplus, it arises due to revaluation surplus, it will be charged to revaluation surplus, which means that we are required to debit the revaluation surplus / OCI. So let me repeat. If deferred tax liability arises from revaluation, then simply the liability is charged to revaluation. Okay. And we have already discussed one more concept. Deferred tax arises only from temporary differences. Deferred tax cannot arise from permanent differences. You can now come here. Deferred taxation, we have discussed. Taxable profit, we know that. We know IAS 12 categorically says deferred tax arises only from temporary differences. Due to permanent differences, deferred tax cannot arise. Okay. Reason for recognizing a deferred tax. I think we did discuss yesterday as well. See, if you're not recognizing the deferred tax, then obviously you are providing misleading, incorrect information to the user of financial statements. Number one, the accrual concept requires its recognition, because we know that in the future we have to pay more tax. So they're just providing us the reasons. Why do we need to recognize deferred tax? One reason is the accrual. The second is deferred tax is a liability or asset which will eventually be settled. Why it will be eventually be settled? Because deferred tax arises only from the temporary differences. Deferred tax cannot arise from permanent differences. The overstatement of profit caused by failing to allow for deferred tax liability could lead to. See, if you are not recognizing the deferred tax liability, then your profit will be overstated. Due to overstated profit, the problem will be over optimistic dividend payment based on overstated profits. Since you are not recognized, your company has not recognized the deferred tax liability, so your profit will be overstated. And overstated profit will lead to over optimistic dividend payments based on overstated profit. Second, distribution of EPS and P ratio, both important indicators of the company, they will also change. Obviously, when your earning will increase, your EPS will increase. And the last point is shareholders being misled. So these are the few reasons why do we need to recognize deferred tax. You should know these reasons as well. Okay, fundamental principle of IAS 12. An entity should recognize a deferred tax liability or asset whenever the recovery of or settlement of the carrying amount of an asset or liability would make future tax payment larger or smaller. I think we have discussed the concept we did discuss yesterday. It is, if due to taxation rules, we are paying less tax today, but in the future we have to pay more tax, then we should recognize deferred tax liability. But due to taxation rules, if we are paying more tax today and in the future we are going to pay less tax, then you should recognize deferred tax asset. In FR examination, you may have to calculate temporary differences. Carrying amount tax base, we know this. Okay. Increase in deferred tax liability. So income tax expense debit, deferred tax liability credit. If liability reduces, then debit deferred tax. This is your asset. Debit your deferred tax asset. And reduce income tax expense OC. Or you can do this. If your deferred tax liability is reduced, so you have just simply debit the deferred tax liability. Reduction in deferred tax liability is debited and income tax expense will be credited. If it relates to, let's say, OCI revaluation, then OCI will be credited. The same thing is happening here also. If deferred, we have just discussed, if deferred tax liability arises from revaluation, then obviously it will be charged to revaluation. When I'm going to debit the revaluation, then obviously OCI will be debited. Okay, IAS 12 requires a deferred tax liability to be recognized for all taxable temporary differences with minor exceptions. They are not in your FR syllabus. A taxable temporary difference arises where carrying amount of an asset is greater than the tax base. The liability will be calculated and provided in full, no discounting. We did discuss yesterday as well. In case of deferred tax liability and asset, there is no discounting. Deferred tax asset. IAS 12 requires a deferred tax asset to be recognized for all deductible temporary differences subject to the restriction. Let's see. A deductible temporary difference arises when the tax base of an asset exceeds the carrying amount, or tax base of a liability is less than the carrying amount. This thing we have covered in a relationship already. If let me take you back here. Look at this. In case of assets, when carrying amount is less, tax base is more, there's a deductible difference, and deductible difference actually results in deferred tax asset. In case of liabilities, if carrying amount is more than the tax base, then difference is your deductible temporary difference. For example, warranty expense provision, they will always result in a deductible temporary difference. Why? Let me just show you. Look at this. Tax base of provision will always be 0. Now, carrying amount, tax base, temporary difference. Warranty provision. I'm assuming that warranty provision is having a carrying amount of 80, but tax base will be 0 because taxation authorities, they do not accept your provision as a liability. So under IAS 37, let's say we have recognized the warranty provision. Taxation authorities simply, they don't assign any value to your provision. So tax base will be 0. So warranty provision is a liability. Carrying amount is 80, tax base is 0. So this 80 will be your deductible difference. And we know that deductible temporary difference multiplied by tax rate will give us deferred tax asset. They have just written this in the explanation. Okay. For example, a warranty expense and provision may be recognized in the financial statement, but tax purposes, the expense would be recognized when paid. We have already discussed this in the previous lecture. So the tax-based provision would be 0. Therefore, warranty provision of tax base is less, carrying amount is more, deferred tax asset. However, the amount recognized as deferred tax asset may be restricted. A deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable, means more than 50% chances, that taxable profit will be available against which the deductible temporary differences can be utilized. Actually, deferred tax asset means your company is going to save tax in the future. But obviously, you will only be saving the tax in the future when you will be having taxable profits in the future. So please read it again. A deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable that taxable profit will be available, against which you can utilize the deductible temporary difference. Okay. Let's deal with this quickly. It says ignore deferred tax. Prepare a statement of profit and loss extract for year 1, 2, and 3. But question says categorically ignore deferred tax. A company's financial statement show profit before tax just 1,000 in each year 1, 2, and 3. The profit is stated after charging depreciation. 200 per annum due to purchase of an asset costing 600 in year 1, which is being depreciated over 3 years useful life. Straight line method. Tax allowable depreciation is here. Income tax is calculated 30% of taxable profit. Apart from the above depreciation and tax allowable, there are no other differences between accounting and taxable profit. But in part A, question says, ignore deferred tax, prepare a statement of P&L. Now look at this. If it's 1,000 every year, okay, tax rate is 30%. Okay. So please, just a little idea. First year, second and third. Profit they have given us 1,000. Can I say we know that tax is paid on taxable profit? We do not pay tax on accounting profit. Simply add accounting depreciation. Can I say the accounting depreciation is 200? Less tax allowable depreciation, which is 240, 210, and 150. Tax depreciation 240, 210, and 150. So simply 1,000 plus 200 minus 240, I'm getting 960 taxable profit. 1,000 then plus 200 minus 210, I'm getting taxable profit 990. And 1,000 plus 200 minus 150, taxable profit is 1050. Taxable profit, okay. Now simply multiply this with the tax rate. Tax rate is 30%. Tax rate is 30%. So let me use the calculator. 960 multiplied by 30%, I'm getting 288. 288. 990 and then 30%. 297. 1050 and then 30%. 315. Okay. Ignore deferred tax, prepare a statement of profit and loss extract. So let's take this as a working one. In extracts, let me make it here. Test your understanding one. Statement of profit and loss extract. Statement of profit or loss extracts. Years 1, 2, and 3. Profit before tax is 1,000. We know that. Ignoring deferred tax, examiner says just calculate income tax. So here comes the income tax expense, which we have already calculated. In the first year, it is 288. Second year, we calculated 297, and then we calculated 315. Don't forget that examiner has asked us to ignore deferred tax in requirement A. That is why we are just directly taking income tax expense. So here comes your profit after tax. profit after tax. 712, 703, and obviously 685. Okay. Now let's go towards part B of the question. Accounting for deferred tax. Prepare a statement of profit or loss and a statement of financial position extracts for each year. 1, 2, and 3. Now examiner is asking us to properly go for deferred taxation as well. Okay. Let's try then. We have already calculated the income tax 288, 297, and 315. So let's come here. Working to, let me show you. Where we did the working one. Let's do it here. Working to. Now we need to work on carrying amount and tax base. Let's say year 1. Years 1, 2, and 3. Carrying amount, tax base. Please, the asset which they bought for 600, in the first year, the depreciation, accounting depreciation is 200. So obviously the carrying amount is 400. Second year, asset cost is 600, but now the total depreciation is 400, which means that the carrying amount is 200. And in the last year, the carrying amount will be 0. So accounting carrying amount in the first year is 400, then 200, and then 0. Tax base. How do we calculate tax base? It is very simple. We calculate tax base. If you recall, tax base of depreciable asset is equal to the tax written down value. Tax base of depreciable asset is actually equal to tax written down value. So in the first year, property, plant, and equipment is having a cost of 600, and in the first year, tax depreciation is 240. So the tax written down value is 360, and this 360 is your tax base. Asset carrying amount is more than the tax base, so there's a taxable difference of 40. Logically, this 40 is a taxable temporary difference. Taxable. And we know that taxable temporary difference multiplied by tax rate gives us the deferred tax liability. Taxable temporary difference multiplied by tax rate gives us deferred tax liability. Okay. Tax rate is 30%. So deferred tax liability is 12. So simply in first year, deferred tax liability is 12. Now, go towards second year. 600. Tax depreciation for the first year is 240, for the second year it is 210. So from 600, if we need to deduct 240 and 210, can I say the tax base will be 50? Again, carrying amount is more than the tax base, so there's a taxable difference of 150. 150 multiplied by 30% gives you the deferred tax liability of deferred tax liability. 150 into 30. Just a minute. Can I say 600 minus 240 minus 210? I'm getting 150. 600 minus 240 minus 210, we are getting 150. 150 is the tax base. Again, carrying amount is more than the tax base. So the difference is the taxable memory difference, which is 50 into 30, it is 15. There is an increase in the deferred tax liability by 3 from 1 year to the second year. Now, let's talk about the last year. Can I say in the last year, property, plant and equipment cost is obviously 600, but tax depreciation for the first year is 240, second year 210, and last year the tax depreciation is 150. So logically in the last year, this tax base carrying amount both are nil. Now students, please listen. In the last year, logically, your deferred tax liability will be 0. In the last year, your deferred tax liability will be 0. Now, in the first year, initially there wasn't any deferred tax liability. So directly there's a deferred tax liability of 12. Increase / decrease in deferred tax liability. There's an increase of 12. There is an increase of 3. From 12, we have reached to 15. But now, can I say there will be a decrease, but it will be decreased by 15. Why? Logically, from 15, we are going towards 0. Repeat. In the first year, there's an increase in deferred tax liability by 12. Then in the second year, there's an increase in the liability by 3. In the last year, your liability has reduced by 15. Just give me 1 minute. I'll show you another presentation. You might like it more than this one. Just deal with year 1. Carrying amount. Tax base. Third column is the temporary difference. In the first year, property, plant and equipment carrying amount is 400. In the first year. Tax base, we have calculated 360. So 40 is a taxable difference. Multiplied by tax rate. Logically, this is your closing deferred tax liability. Less opening deferred tax liability, which we don't have it. Then you get deferred tax expense of 12. Second year, year 2. Carrying amount, tax base, temporary difference. Property, plant and equipment. Carrying amount we have calculated, it is 200. Tax base was 150. So there's a difference of 50, which is a taxable temporary difference. Multiply by 30%. 15 is a closing deferred tax liability. Minus the opening deferred tax liability of year 1. Because closing deferred tax liability of year 1 becomes opening deferred tax liability for the second year, which is 12. This 3 is your deferred tax expense. Because liability has increased, deferred tax expense. Third and the last year. Carrying amount, tax base, and temporary difference. They are 0, 0, 0. Then obviously closing deferred tax liability will be 0. Now closing of year 2 becomes opening for year 3 less opening deferred tax liability, and opening will be this. Because closing of year 2 becomes opening for year 3. There is a reduction in the deferred tax liability by 15. Now deferred tax liability is not increased, it has actually decreased. Due to reduction in deferred tax liability, your income tax expense will reduce. Repeat, due to reduction in deferred tax liability, your income tax expense will reduce. If I just quickly show you the double entries of each year. In year 1, there's a deferred tax expense of 12. If you ask me, sir, what is the entry? So simply you can make the entry. Income tax expense debit by 12. Deferred tax liability credit by 12. Here, only 3. Debit and credit. Income tax expense debit by 3. Deferred tax liability credit by 3. In the last year, liability has decreased. Deferred tax liability debit by 15. Now, income tax expense is credited by 15. So these are the just double entries. Okay, now year 1, 2, and 3. If we calculate income tax expense, please, in the first year, we have calculated income tax 288. Second year, we calculated 297, and the last year, we calculated 315. Now, in this income tax, we have to adjust deferred tax expense. So in the first year, deferred tax has, due to deferred tax, there's an expense of 12 million in the first year. In the second year, it is 3. Can I say in the last year, there's a reduction of 15. Look at this income tax expense. Every year, we'll get income tax expense of 300. Every year, we will get income tax expense of 300. Now, if I just quickly prepare extracts of a statement of profit and loss in part B, statement of profit or loss, extract. Years 1, 2, and 3. Profit before tax, they have given us 1,000. Now income tax is 300 every year. Income tax expense is 300. Here comes your profit after tax. Extracts of SOFP, statement of financial position extract. Years 1, 2, and 3. Non-current liabilities. Deferred tax liability. First year it is 12, then 15, and then 0. In SOFP, you will always show the closing liability. Current tax liabilities. The current liabilities. Simply current tax payable. Student, in the first year, we calculated 288, then 297, and then 315. So these are just the extracts of SOFP and obviously as well as profit and loss. Okay. Now let's go back to the question. We have done this. Revaluation, we have already discussed. If your deferred tax liability is arising from the revaluation surplus, can I say it will be charged to revaluation surplus? Repeat. If your deferred tax liability arises from revaluation surplus, then it will be charged to revaluation. Repeat, if your deferred tax liability arises from revaluation surplus, then it will be charged to revaluation, and which we did it also. Okay, now tax losses. Basically, let's say in 2024, assuming companies having the tax losses of 100 million. Assuming in 2024, companies having a taxable losses of 100 million. Okay. Actually, taxable losses multiplied by tax rate will give you the deferred tax asset. Repeat, taxable losses, because from these taxable losses, we are going to save tax in the future. How we will be utilizing these losses? Obviously, these losses will be utilized against the future profit. When this, let's say when this organization is going to have taxable profit in the future, then from that taxable profit, we will deduct this taxable loss. So simply taxable losses, they result in tax savings. So taxable loss multiplied by tax rate gives you deferred tax asset. Okay. But the question is, should I recognize the deferred tax asset according on the basis of entire 100 million loan, the loan which company is having? So according to IAS 12, when there are losses in your company, then you have to do one thing. Logically, you will have to estimate the future profits. For example, if in the future, let's say company has estimated that in the future, we will have the taxable profit of 80 million only. Right now, we are having a loss of 100 million, but in the future, let's say they have estimated for first year, second year, and third year as well. But the total taxable profit which they have estimated, it's going to be assuming 80 million. If this is the case, then a student, you cannot recognize the deferred tax asset on this entire 100 million loss. Instead of 100, then you will be recognizing a deferred tax asset on the basis of 80 million. So you have to make sure that what amount of profit you are going to have in the future against which you will be utilizing the taxable loss. If your estimated profit for the future is less than the taxable loss, then obviously whatever is the profit amount multiplied by tax rate, you will have to recognize deferred tax asset. If your future taxable profit, which you have estimated, it is more than 100 million, then obviously 100 million multiplied by tax rate, you will recognize the deferred tax asset. The losses may generate a deferred tax asset because if those losses are carried forward and sufficient future taxable profit are expected to be available, it will result in the reduction of future tax payable. In such circumstances, we should be skeptical because there is no guarantee that you are going to have profit in the future. We should be skeptical of the projected future profits given the company's historical loss-making performance. If, however, the entity is part of a group and may surrender tax losses to other group companies, a deferred tax asset may be recognized in the consolidated accounts. If, for example, subsidiary has surrendered its loss to the parent and group is saving the tax, then in the group account you can recognize, in consolidated accounts in the group account you can recognize the deferred tax asset. If, however, the entity is a part of a group and may surrender tax losses to other group companies, a deferred tax asset may be recognized, but look at this, the books are group accounts, consolidated accounts. The asset is equal to the tax losses expected to be utilized multiplied by the tax rate. Okay. Then we are having a test your understanding too. In test your understanding too, what are they asking? They are again asking us to prepare extracts from the financial statement to show the effect of above transaction. Let's see. On January X8, Simon Company decided to revalue its land for the first time. And we know that taxation authorities, they do not accept revaluation. Okay. A qualified property valuer reported that the market value of the land on that date was 80 million. The land was originally purchased 6 years ago for 65. So you can see that there's a revaluation surplus of 15,000. There's a revaluation surplus of 15,000, and we have just discussed if deferred tax liability is arising. If deferred tax liability arises from revaluation surplus, then it will be charged to revaluation. If deferred tax liability arises from revaluation surplus, it will be charged to revaluation surplus. Okay. The income tax liability for the tax year December exit is 19,400. The difference between the carrying amount of the net asset of Simon, including the revaluation of the land above and their lower tax base, is 27,000. Okay. The opening balance on the deferred tax account was 2,600. Simon's rate of tax is 25%. And they're just asking prepare extracts from the financial statements to show the effect. Okay. I think let me repeat again the same concept which we have just discussed. Can I say, students, if deferred tax arises from revaluation surplus, then simply it will be charged to revaluation. Okay. One more thing which we have already discussed, that is carrying amount and tax base. In case of assets, when carrying amount is more than tax base, then difference is the taxable temporary difference. So Azan is sounding, just 2-minute break, then we'll be discussing together. Let me pause the video. Test your understanding too, please. Okay. Test your understanding too. Carrying amount, tax base, temporary difference, land. Carrying amount is 80,000. Tax base is 65. So can I say there's a difference of 15,000? Obviously, there is a taxable temporary difference. Taxable temporary difference multiplied by tax rate gives us the deferred tax liability. And we have already discussed one point. If your deferred tax liability arises from revaluation surplus, then it will be charged to revaluation surplus. Okay. Tax rate. What is the tax rate? Tax rate is 25%. And please check here. The difference between the carrying amount of the net assets of Simon, including the revaluation, which is 15,000, and their tax base, is total difference is 27,000. Out of this 27, don't forget 15,000 difference is coming because of the revaluation surplus. If 15,000 difference is coming because of the revaluation surplus, then 15,000 into 25%. Can I say 3750? This much liability, which is 3750, will be charged to revaluation surplus, because when deferred tax liability arises from revaluation, then it will be charged to revaluation surplus. Now, please try to understand. Don't forget this. The effect of deferred tax liability, 3750, will be charged to revaluation surplus. So, space, we need a space. Just a minute. Total taxable difference, examiner has given us 27,000. How come 27,000 is a taxable difference? Please, if you read the question, it is written, carrying amount of net asset of Simon is more than the tax base. When assets are having carrying amount more than the tax base, assets are having carrying amount more than the tax base, then difference is the taxable temporary difference. So basically, we're short of space. Taxable temporary difference is 27,000 multiplied by 25%. I'm getting the closing liability 6750. It is our closing deferred tax liability. And we know that in SOFP, we have to show the closing deferred tax liability, which is 6750. Okay. Less opening liability, opening deferred tax liability. They have given us the opening deferred tax liability 2,600. Less the deferred tax liability 3750, which relates to the revaluation surplus. Less deferred tax liability relating to revaluation. Charge to revaluation 3750. So let's see what is the amount of deferred tax expense. $6,750 minus 2,600 minus 3,750. I'm getting 400. Please listen carefully, students. Your income tax expense will be increased by 400. Your income tax expense will increase by 400. The revaluation surplus will reduce by 3,750. Revaluation surplus will be reduced by 3,750, because when your deferred tax liability arises from revaluation surplus, then it is charged to revaluation. Income tax expense will increase by 400. Revaluation surplus will reduce by 3,750. Now, if I just show you the extracts here quickly, you have seen the calculation. Just a minute. statement of profit or loss and other comprehensive income. The student income tax expense will increase by 400. They have given us the income tax expense 19,400. Current liability is 19,400. So simply income tax expense. 19,400 plus 400. It will be 19,800. Other comprehensive income, OCI. In the current year, company has recognized a revaluation surplus. Revaluation surplus of 15,000. But from this 15, deferred tax liability, which we have calculated, 3,750 will be deducted. So revaluation in the current year, it is 15,000. And relating to this revaluation, there is a liability of 3,750. So final, or you can say the remaining revaluation will be only 11,250. So income tax expense is 19,800, and in OCI, other comprehensive income, after deducting 3,750 for the deferred tax liability, remaining revaluation is only 11,250. If you ask me the extracts of SOFP, so in SOFP, we have to show the land, and now the value of the land is, I think I'm just short of space. We can go here. No, let's come here. Now, fine. Extracts of SOFP. I'll be a bit quick because of prayer time. Non-current asset. Now the value of the land is 80,000. Equity. In equity, revaluation surplus will not be 15. Can I say 15,000 minus 3,750? The revaluation is 11,250. Non-current liabilities. Deferred tax liability closing 6,750. Current liability is the income tax payable, which they have already given us. Current liability. Income tax payable is 19,400. So these are the extracts of SOFP and PNL. And at the end of this PDF, I have given all the answers. Don't worry at all. So this is just a summary what we have studied: income tax, deferred tax. Test your understanding 3 is a complete final account question. So right now there's no need to do this. I think just if you just go, I think 2 lectures back, we did discuss at least one question of the final accounts. But at the end of all IAS and IFRSs, we are going to learn, and we will be studying separately the entire topic of final accounts. I think the question number 4 is exactly in the same way. Question 5. Question 5 is important. And this question number 5 and other questions we will discuss, but after the prayer break. So class will resume within 30 minutes, and I'll drop the message in your relevant WhatsApp groups. Okay, let's resume the class. And at the end of the class, don't worry at all, I'll share IAS 12 test as well, which you can solve. I will give you a little bit time also, at least a day, at least one day, you will be having to solve that test. Okay, test your understanding 5. The following information has been extracted from the accounting records of Clara Company. Estimated income tax for the year ended 30th September X0 is 75,000, but actually the tax paid is 80. We did discuss the concept of under provision and over provision. Under provision, what under provision does, it actually increases your current year income tax expense without having any impact on your current year tax liability. In case of over provision, your current year income tax expense will reduce without having any impact on the current year income tax liability. So it can be seen that there is a 5,000 under provision because they made the provision of 75, but they end up by paying 88. Select the amount that will be shown as an expense in the statement of profit and loss. Obviously, it will be 88,000. 30th September X1, and as a liability. So liability will remain 83,000. Under provision, let me repeat what under provision does. Under provision increases your income tax expense without having any impact on current year liability. Okay. Select the amount that will be shown as an expense. Can I say so? Expense is going to be 88. Liability will be 83. Tamsin company's accounting records show the following. Okay, fine. Income tax payable for the current year profit is 60,000. Over provision in relation to the previous year. We have just discussed right now. What over provision does, actually over provision reduces your current year income tax expense without having any impact on current year liability. So from this 60,000, we will deduct this 4,500. Opening deferred tax liability is 2,600, closing is 3,200. So basically, closing is 3,200 and opening is 2,600. There's an increase of 600. This increase is actually representing the deferred tax expense. This increase is representing the deferred tax expense, and deferred tax expense increases the income tax expense. So closing liability is more than the opening liability. Since closing deferred tax liability is more than the opening liability, there is an increase in the liability by 600, and this 600 will increase income tax expense. What is the income tax expense? So simply, let me use the calculator. 60,000 minus 4,500 plus 600. I'm getting 56,100. Okay. A piece of machinery cost 500. Tax depreciation is 220. And depreciation charge in the financial statement is 100. Tax rate is 30. What is the deferred tax liability? Look at this. Carrying amount. Tax base. Temporary difference. Machinery cost is 500 and accounting depreciation is 100. So the carrying amount is 400. Depreciable asset tax base is equal to tax return on value. So from this 500, we will deduct the tax depreciation, which is 220. So tax base is 280. Assets carrying amount is more than the tax base. Assets carrying amount is more than the tax base. So when carrying amount is more, tax base is less, there's a taxable difference of 120 into tax rate. So it will result in a deferred tax liability of 36. So simply the carrying amount is 400, tax base is 280. In case of assets, we know that when carrying amount is more than the tax base, then difference is the taxable temporary difference. Taxable temporary difference multiplied by tax rate gives you deferred tax liability. Prepare extracts from the statement of profit and loss and statement of financial position of WS company for each of the 3 years, showing the tax charge and tax liability. prepare extract from the statement of profit and loss. So we have to prepare extracts from the profit and loss and financial position as well for each of the 3 years. So let's read. WS company prepares the financial statement to 30th June. The following profit before tax were recorded in X1 and X3. So in X1, it is 1 lakh, 120 and 110. The entity pays income tax at a rate 30% and incorporates this figure in the year-end accounts. The actual payment of the tax paid is in respect of 2000 X1, X2 were 28,900 and 37,200. Very important point. Actual payments relating to X1 is 28,900 and relating to X2 it is 37,200. Okay. Now please try to understand. 2000 X1 multiply by 30%. WS prepared its financial statement. The following profit before tax were recorded. If I take 30% of 1 lakh, it is 30,000. Now try to understand. In 2000 X1, we have calculated income tax liability, let's say 30,000, but actual payment is not 30. Actual payment is only 28,900. Since the actual payment is less than the liability which we have recognized in 2000 X1, so it means in X1, we have recognized a liability more than actual payment. So this difference is representing the over provision. And what over provision does, actually over provision reduces your current year income tax expense without having any impact on your current year liability. And we also know one thing, that over and under provision issue will arise in the following year. For example, whatever you have recognized in X1 relating to that, if there is any under provision or over provision, you will get to know in X2. And that under over provision will affect the income tax expense of X2. And relating to X2, if there is any under provision or over provision, you will get to know in X3. And your under or over provision of X2 will actually impact income tax expense of X3. So let's try here. Let me show you one working. So actually what has happened in 2000 X1, we have recognized the corporate tax liability of 30,000. This is your tax payable. In X2, if I take 30% of this, it is 36,000. But actual payment, it is 28,900. Here actual payment is 37,200. 1,100 is actually the over provision. And here 1,200, I'm having the under provision. Never forget one thing. What under provision does, actually under provision will increase your income tax expense and over provision will reduce your income tax expense. It means that, okay, great. Working to 2000 X1, X2 and X3. Current tax, it is 30,000. It is 36. Multiply by 30%. Obviously 33,000. Now, we will less over provision and slash add under provision. So basically, this negative sign should not disturb you. If this negative sign is disturbing you, so you can do one thing. Let me show you that. Conceptually, we know that over provision reduces your income tax expense. So 1100 will reduce your income tax expense, but the 1200 will increase your income tax expense. Why? Because 1200 is the under provision. Under provision, what it does, it increases your current year income tax expense. So income tax expense, it is 30,000. 36,000 minus 1100, I'm getting 34,900, and here 34,200. Okay. Now, statement of P&L extracts. Same thing will go to the statement of P&L extracts. Statement of profit or loss extracts. X1, X2, and X3. Income tax expense 30,000. 34,900. 34,200. SOFP. Statement of profit or statement of financial position. Statement of financial provision as at X1, X2, X3. Simply current liabilities, income tax payable. Current liabilities, we will show income tax payable. Income tax payable. In the first year, it is 30,000. Second year, we have calculated 36, and last year it was 33. Because we have discussed many times under and over provision, they only affect your income tax expense without having any impact on your income tax liability. Let's go for the last one. What is the double entry necessary to record the deferred tax impact of the warranty provision? I think we have already discussed taxation authorities do not accept provision as your liability. So the tax base of the provision will always be zero, and provision they will always result in deductible temporary difference. And due to deductible temporary differences, deferred tax asset will arise. So carrying amount, tax base, temporary difference, warranty provision. CP company introduced a warranty scheme during the year ended 31st March X1. CP company's statement of financial position at X1 recognize a warranty provision of 65. Tax base will be 0. So 65,000 is a deductible temporary difference. Deductible temporary difference multiplied by tax rate gives us deferred tax asset 13,000. Double entry will be debit and credit. Deferred tax asset will be debited, and income tax expense will reduce. Income tax expense. Basically, deferred tax liability. When deferred tax liability increases or it arises, then it increases your income tax expense. Whenever we are going to recognize a deferred tax asset, it will reduce your income tax expense. And let me just quickly share the test of IAS 12, what I'm expecting from you to attempt. Then there will be an important announcement. Wait for a minute. Okay, students, this is your IAS 12 test. It's not a very long test. I think hardly there are 20 questions. So I really want every one of you try to attempt this test. And what I'm going to do, I'll tell you that also. Actually, there are two options. You can choose any one of them. Number one, video lecture on this test will be uploaded by tomorrow evening. But I will give the opportunity to those students, they have time. Obviously, everybody will not have the time. Those students, they have the time. So I'll be recording the lecture on this test uh, early in the morning, Pakistan time. So I'll drop the message in your relevant WhatsApp groups if you have time. So obviously you can attend the recording of IAS 12 as well. Otherwise, I'll upload the recording on the portal. It will be available by evening. But I really want every one of you to at least attempt this test on IAS 12. So simply, thank you very much. And after this test, students, we are going to start the new IAS. Okay. So thank you very much. Have a nice life. See you all tomorrow.